we talk about accounting as a language, right? Just like every language, there are rules. Okay, we have English grammar. It's different than Japanese grammar. That's different than all the other languages. So for languages, spoken languages, the rules of the grammar have been developed over time, and whatever they've changed, right? If you read Shakespeare, it's like sounds different than we speak now, right? In the same way, accounting has its own rules, its own kind of uh, the grammar of accounting. In the U.S., we call this language U.S. GAAP, and GAAP stands for Generally Accepted Accounting Principles. Okay, so this is our accounting language that we use in America, and any American company that's like large and has like definitely all the companies that are trading on the stock exchange are gonna follow these rules of accounting. Okay, um, what are they? It's a set. It's like and I'll show you in a second what the codification looks like. It's kind of like a law book. Okay, it's organized by the different kind of accounting questions, and there's kind of a guidance as to how a company that's following this rule book should present things that are kind of part of that topic. Okay, so it's arranged by topics, and it not only has like kind of the high level law, but it also has additional guidance that we'll talk about the organizations that are involved in a second. They're like they give you extra detailed uh, kind of examples and like how to implement the law, essentially. Okay, so um, but it's essentially like a book of law, a book of grammar, and uh, they're organized into these standards. Okay, you're going to hear this term maybe especially if you go into accounting, the GAAP standards. Okay, these are kind of like whenever we have new laws that are passed, they have like there's a bill, and that bill is going to contain amendments to existing law or like new additions to existing law. So it's the same thing with these accounting rules. Um, there's also again technical guidelines as to how to implement these standards. Okay, because uh, it's not always it's written kind of in broad language, and so when it comes to actually applying them, the there's also additional detailed guidance on how to do that. The reason why, like why why do countries, uh, let's take India for example. Okay, India, in each little part, there's like a dialect that's spoken. Okay, why would the country want to have a national language? What's the advantage of that? Exactly. Okay, so in a country, if everyone speaks one language, you can go from one part of the country to the other, and you can still communicate with people. Okay, it's the same with this accounting language. Okay, the reason why we want to follow these rules of accounting, is that you as an investor or you as a lender, you only have to really learn one language. You have to learn U.S. GAAP, and if you know U.S. GAAP, you can then read the financial statements of every country or every company that's following U.S. GAAP. Okay. If every company had its own accounting rules and kind of guidelines, you'd have to learn that. You'd have to learn a different language for every company, and that'd just be too time consuming, right? So, as a benefit to both the companies and to investors and all these third parties, it's been kind of agreed upon that there should be one set of rules. Okay, so that's why this exists. Okay, that's essentially it makes the life of all these people involved in capital markets and business, it makes it easier for everyone to communicate with each other. Okay, there's not always a right answer in accounting. Okay, that's why if there was an objective truth about how a company should do something, then we wouldn't need different rules, right? We would just have some objective truth. Okay. Um, like the laws of physics, there's not one, not every country has a different, force of gravity. or acceleration from gravity, right? That's a universal constant. But accounting, there's many, many, many topics that come up that there's no right answer for. Okay, so someone has to decide what rules we're going to follow. So here are some examples. Research and development. Okay, you're a biotech company. You're spending most of your money on research. Now the question is that an expense, meaning that it's not going to give you any future benefit and it's just like kind of gone and you spent it just like you pay salaries for your workers? Or should you treat it like an asset, meaning something that you're going to derive future benefit from? Does anyone have an opinion on this? Which one makes more sense? And then I'll tell you what the US GAAP finding is. You think it's an asset? Why? I'll relate it to your guys' lives. Okay, you're spending money on college, right? Is that an expense? Are you they say you're investing in yourself, right? You're creating this educational asset, right? So it's the same thing with R&D. The way that US GAAP treats R&D is that it's expense, meaning the company just, it's like you going to school and you just write a check for 10,000 bucks and it's gone. You won't show any, uh, even though for your lives, you know that that degree that you're working towards is going to be an asset for you. You're going to be able to earn more money. Um, for the company, they kind of know that too. Their research is leading somewhere, but they're not allowed to show it as something valuable that they're investing in. They have to expense it as per US GAAP. Why is that? Because US GAAP is conservative. You don't know if that R&D is going to actually turn into anything real, right? So as per the accounting standards, you're just going to assume it's all like being wasted, even though we know in the reality some of that R&D is going to become valuable, right? But the accounting standards are such that they don't want that. They want you to assume that it's going to be like all go to waste, okay? Because it's too hard to determine what is actually good R&D versus bad, right? So the rule makers have decided that it's all just treated as bad, and it's going to be you're going to show big losses, right? Your income statement, we're going to see how this works. You're going to show a lot of losses because of this, okay? But that may not be the case. If you're a biotech investor, you're not going to be so focused on that. You're going to be looking at the research, what they're doing. So, but the accounting reports will look bad. Derivatives and mark to model. Okay, so this is another one. Let's say I'm betting with, I'm a bank, I'm betting against the price of copper against another bank. Okay. In the case of copper, there's like an actual market, but let's say it's something weird, like some meme coin. Okay, I'm one bank and I'm betting against another. There's no actual market for that bet, right? It's like kind of like it's a bespoke kind of, it's a specialized kind of thing that I've engaged in with this other bank. Okay, um, the accounting rules are strange, such that both of us can show a profit. Okay, let's say we're betting against like you're betting copper's going up, I'm betting copper's going down. If it's not in the case of copper, it's like very easy to tell what it's worth. Let's say R&D. Okay, I'm betting that this R&D is worthwhile and this R&D is not. Okay, if there's no like objective way to tell who's winning, the rules are strange. This is like you could argue a big like flaw in the rules. Both of us can say, hey, I have like an Excel spreadsheet model that shows that my bet is doing good. And the other person can have their own model that shows that they're doing good. Even though both of us can't be doing good, it's impossible. Okay, so this is a flaw. This is a part of the rules for certain instances where for certain transactions, these are like financial derivatives that don't have a very liquid market. The accounting rules allow the owner to use their own kind of calculations to figure out what the thing is worth. Okay, of course, you're gonna like say your thing is worth more than it is probably if it was left to your own kind of thing, right? Um, so that's another flaw, right? Okay, and hold to maturity bond accounting. Okay, so this is Silicon Valley Bank. Does anyone remember what happened to them? It happened like I think a year or two ago. Yeah, they collapsed, right? It had to do with an accounting rule. Okay, we'll go into this. They were actually following all the rules of accounting. Okay, they did nothing wrong, but the rules of accounting are not fully lined up with the real world. Okay, and so there was an accounting rule that they were using. It was to their advantage. It was not correlated with the reality of how much their kind of investments were worth, and that caused them, you know, one of various factors to go out of business. So these are just some examples. I'm just trying to illustrate to you that there are things that happen in business that it's not easy to figure out what to do with. Okay. So the accounting rules are not perfect. They differ, right? The European standards are different than American on various topics. Okay. Because they have their own opinion of what is right and wrong. Okay. So, um, but yeah, in the US, we have a certain set of standards. What we're going to learn in this class, it's like mostly transferable. We're not doing any like very complicated kind of accounting issues. Um, but I just wanted to you should all be aware that the rules that we're learning are not like sent from, up above. They are determined by people and they're not always correct. And that's why they keep changing too. If they're not sent from the gods, who are creating these rules? Okay, there are some organizations that are involved in this creation of the accounting standards. Um, in financial accounting, the FASB is the main organization. It's a nonprofit. They get their funding from uh, all publicly traded companies contribute to this organization because they all benefit, right? We just agreed that if everyone is speaking the same language, that it's going to be a benefit to everyone. And so all the companies that are kind of mostly benefiting from having that one language are financing this nonprofit they're just like accounting nerds. Okay, this is all the accounting PhDs and people that think about all these accounting topics. They're in this organization, and whenever there's crypto, okay, this is a new accounting topic. How should crypto be accounted for? Okay, so there's probably some working group there that's thinking about that. Okay, and they'll release standards on how companies should report their crypto assets or digital assets, whatever you want to call it. The SEC is uh, it's a federal government organization, and their job is to just kind of oversee all the financial markets in the country. Okay, so they're not the accounting nerds. The accounting nerds are the FASB. Technically, though, since the SEC is like the enforcer, they have a say in these standards too. Um, so they're also involved in this creation of US GAAP. The PCAOB, this is a organization, another governmental kind of organization that was created after some big financial scandals in 2001, which we'll talk about, the Sarbanes-Oxley Act. But they're specifically looking at public companies, um, because remember, in America, there's like many companies are not traded on the stock exchange, right? There are any company that venture capital invests in before they go public, they are like Uber for a long time. It became a multi-billion-dollar business, and it was not you and I could not buy shares in Uber, right? Because it was a private company, right? But they still had stock, right? It just wasn't publicly traded, right? There's a difference between public companies and private companies. Private companies have stock, they have shareholders, but they're usually like larger institutions, and there's certain rules about investing in private companies that actually the SEC sets. But the public company oversight board is only related to public companies. Okay, so there's trade-offs to this. Okay, a private company has far less regulation. Okay, they're they they're not really regulated much at all. Okay, it's really, if the shareholders were not happy with the reporting, then they would have to bring it up with the board. And once you go public, you're gonna be subject to a ton of oversight, and a ton of regulation. Why? So why would a company do this, right? The access to capital is much larger for a public company, right? You just have a much big, it's like supply and demand, right? The supply of capital available to a company once it goes public is large. And so that usually reduces, they'll have to issue less shares essentially to raise a certain amount of capital. It's a cheaper form of financing, basically. It's like, would you rather have a 10% loan from a private lender, from your like buddy, or go to the bank and borrow for 5%, right? The bank loan, you're going to have to fill out all the applications and do all this stuff, but it's a cheaper interest rate, right? Um, the private guy is not going to really care. Maybe it's your buddy, but he's going to charge you more for that, right? So that's kind of the trade-off. Public to private, yes. That's what we hear this, they get a lot of bad rap in the news, but private equity firms, what do, right? Private equity firms are basically, there's people that flip houses. Private equity flips businesses. Okay, so what they will often do is take a public company that's poorly run, buy all the shares, take it private, reshuffle things around, usually like laying people off, cutting costs, rearranging the business, and then they'll re-IPO it. Yeah, it's possible, but there'd have to be a big buyer that can buy the whole thing. And usually that's going to be either the like the New York Times Company. Okay, that's all family owned. They own the majority. Actually, the economic interest, I'm not sure. They control it. The Salzburger family, they've owned it for like hundreds of years. There's like the Walmart family. Walmart. They Between all the family members, they control a controlling interest in Walmart. So if they wanted to, since they already own, let's say 55% of it, they could go find other financing to buy the rest of that 45% and take it private. That things like that do happen.